Hello, everyone. My name's Max Borg. I'm a partner at Burns & Levinson in the cannabis practice. We're really excited to do this panel on capital markets and financing sources within the cannabis industry. We have a great panel to join us today. I thought rather than me introduce everyone, I would go down the line and have everyone talk a little bit about the role that you play within the industry and within the capital markets. So we'll start with you, David.
Thanks, Max. Good morning or good afternoon, wherever we are. My name is David Bunzel. I am a Senior Managing Director at Young America Capital. We are an investment bank located in Mamaroneck, New York. We operate across multiple verticals. Cannabis has traditionally been one of our largest. I head M&A for the group. We do everything from large M&A all the way down to equity and debt raises for small to large companies in the cannabis space. We've been fortunate enough to work on quite a few transactions. We've closed 4 transactions in Florida, 6 in Pennsylvania, New Jersey, New York, our backyard. Very busy in those states. And we also work on restructurings, which have been quite active for the last year or so.
Hey, good afternoon, everyone. I'm James Daly from Needham Bank, Needham, Massachusetts. I'm from our structured finance group, which manages and houses our cannabis loans. We focus on offering traditional debt instruments to cannabis companies in our backyard and by supporting some MSOs nationwide as well.
My name is Travis Goad, Managing Partner at Polaris Capital Group. We're the longest running dedicated CRE lender to the space. Closed our first cannabis transaction in 2016, done about $500 million since inception. Kind of one of the differentiators that we do is warehouse everything on our own balance sheet. We don't syndicate transactions, so it's a smoother process from the borrower perspective. We were the first to get a FDIC-insured line of credit, or line of credit from FDIC-insured bank. We were the first to do a corporate bond, the first to be single A rated, and we just did the first securitization that has been done in the space this year. So we're very excited about that.
Hi, I'm Peter Sack. I'm a managing director with Chicago Atlantic. We're a lender to cannabis companies from large public MSOs to smaller private single state operators. We operate in nearly every state level jurisdiction and have deployed close to $1.8 billion over the last 5 years.
Hey everyone, can everyone hear me okay? Just want to confirm that. Great. My name is Bobby Chironi. I am a principal here at Measure 8 Venture Partners. Measure 8 is a cannabis-focused asset manager based in New York with a little bit over $360 million in AUM. We've been deploying capital to the space since 2018. Our primary focus is in the private markets, minority stakes, and private businesses across the sector, sort of agnostic to jurisdiction, geography, license type, plant touching, non-plant touching, you name it, we look at it. Happy to be here.
Well, thanks everyone for joining us. David, I'd like to start and just talk to you a little bit about what you're seeing as the greatest need within the marketplace for raising capital and where you're seeing success in terms of placing capital.
Well, it's certainly been interesting. I would say for the last year, it's pretty much been a nuclear winter in terms of equity. But I would say things are certainly looking up over the last couple of months. I was at another conference in the Midwest just a couple weeks ago, and I would say the mood was really incredible compared to the last couple of years. And really depending on the silo, M&A is always busy, and we're seeing a lot more activity there now as some of the pubcos start to ramp up again some of their activities. On the financing side, equity, at least minority equity, is still very difficult, but starting to also come get unlocked. And thank God for the debt markets and some of the people on the panel here, because that's really what has been keeping us busy, at least for the last year. I would say the greatest need, to answer your question, we really need more lenders in the space that are not looking to be traditional senior secured lenders against real estate. We really are in desperate need of people willing to take a second position or willing to do mezz. And I'd say that's the biggest need that I see among my client base.
Yeah, I appreciate that. And with multiple funds on this panel as well, I'd be interested to hear about where folks are at in the capital raising space as well. Travis, if you could talk a little bit about that, maybe this recent securitization.
Sure. Yeah. So rates reset this year in a big way as it's impacted every market. So I think it's certainly impacted cannabis as well. So capital raising environments have just shifted. However, we've still had quite a bit of success this year. We finished last year at about $365 million in AUM. We're going to finish this year probably around 450. So we're still growing, and constantly what we're trying to do is innovate in the space and bring in more capital to cannabis. And so to touch on the securitization, I mean, the current outstanding issuance of commercial mortgage-backed securities, it's about a $500 billion market. And so that's a tremendous source of capital that most mortgage REITs and other people can tap in order to structure deals that work for borrowers. And those doors have all been closed for the longest time. So here at Plurus, we spend a tremendous amount of time trying to, I joke, kind of crowbar open the doors to the traditional capital markets and give us access to the same things that other people have access to, because the industry's growing, and it's you need to lay those tracks, is how we look at it, for long-term success.
Right. And in terms of looking for that long-term success, we heard the restructuring discussions this morning. There was maybe a little bit of doom and gloom, but looking forward, I'd be interested to hear from each of you just what are some exciting opportunities that you're looking at, or what are some of the exciting companies that you're looking into investing?
I think there's a lot of opportunity in this space. One, there is some distress, so I do think valuations have come down. But one of the things I'm generally excited about is we've had nothing but negative news catalysts in cannabis for the last, call it, 18 months. Cannabis equities are down 80-90% over that time. And we finally got our first few positive news catalysts with the recommendation on rescheduling, as well as SAFE or getting out of the Senate committee. Again, now some drama in the House, so we'll see how that plays out. But ultimately, I do think there are positive catalysts to the industry, and at today's valuations, it's attractive, and there's really opportunity to deploy capital.
Right. And it's interesting, in this industry, the idea or the discussion of federal movement, of federal legislation, is something that we've all been hearing about for years. And I'd be interested to hear whether there's any real feedback or real increase in interest from LPs, as how is this affecting LP discussions?
I think there's some progress. Progress is always positive, and progress with reasonable conversation with regulators and lawmakers at the federal level and the state level. But I think still the most important driving conversation is the asset level, state-based movement that's happening, because that has real tangible benefits. And I think those are some of the real glimmers of good news that we have had in the last 18 months. We've had Missouri go from medical to adult use. We had Maryland go from medical to adult use. We have Ohio going on the ballot in November. And those are part of the steady transition that we see, and that's going to help drive the conversation at the federal level as well.
Right. It's interesting whether we see additional emerging markets constantly, and yet at the federal level, it's like, who knows,
Yeah. But I think the rescheduling is one of the most interesting things. If you think about it, Biden came out and he said, hey, review the status. So it's an executive branch motion, right? And then the health secretary, which is also under the executive branch, recommended rescheduling to the DEA, which is also under the executive branch. So the idea that might get shot down or not go through seems low, and that would be a tremendous positive catalyst for the sector. And I think 280E is the biggest issue facing cannabis today. And if that goes away, it's immensely positive for everybody.
Yeah.
I'd agree with that, actually, because even just in the last couple of weeks, we've started to see a lot new entrants into the market. Private equity shops starting to do work, even though they still can't invest. Sin strategics were early adopters, but now you're starting to see more strategics. So I think there's a lot of new entrants that are going to jump into the market in the next couple months as a result.
I'll just make a comment. I think that if you are an LP that deployed to a vintage in a space, call it in the 2018, the big RTO year, sort of timeline, there's a lot. I mean, there's a lot of frustration. I mean, who wouldn't be frustrated, right? And I know we're talking a lot about federal catalysts, which obviously are extremely important. That's why most of us are sitting where we're sitting. But a lot of RLPs, for example, and others that we've spoken to, they're like, listen, we've heard it before. We've heard that SAFE was imminently passing. We heard that Washington was on the verge of legalization during even the Cole memo times, right? So I think it's just fatigue. Most of the folks are just showing fatigue, but ultimately, if you look at the sort of cycles on emerging markets, the longer you stay in the game, obviously, the more you will be rewarded in the end. I think we are very lucky. I think Peter mentioned something before just about states coming online. We are lucky that fundamentally there's still a lot of green shoots in the space. So being able to lean on that is important. Companies that are growing at scale, ancillary service businesses that are hitting profitability targets. As long as you can either tout some of those in your own portfolio, and that continues to bear fruit, I think that LPs will remain satisfied. But it's difficult managing the emotions around a federal catalyst, right? It's betting on government is always a hard thing to do. And the difficult thing, I think the most difficult thing about it is it's almost like action equals inaction, or inaction equals action, I think is a better way to put it. So it's like a letter from the HHS. It's not actually an action, right, but the stocks move as if it is. So then when we realize things take 12, 18 months to actually understand what that means in terms of a law being passed, people's sentiment changes and it kind of comes back in. So it's a cycle that we've been dealing with, but you just have to focus on the fundamentals.
And I think that's especially true for lenders. The lenders that have taken risk on federal catalysts over the past 5 years have really struggled, because you have to focus on the fundamentals of the business that you're investing in, and so that's I'd say probably the biggest reason why you've seen some lenders drop out and some lenders stay in. It's where did they stretch, and did those bets on a regulatory change pan out or not pan out?
And I did want to follow up, David, on one comment you made about seeing more private equity coming in, and what does that look like right now? Right? Are they doing diligence? Is it diligence and waiting to see the real movement at the federal level? Can you just expand on that a little bit?
Yeah, sure. Well, it's a big universe. It just depends on the institution that you're talking about. Sin Strategics jumped in quickly. We've seen just in the last couple of months mostly just kicking the tires. Private equity. We've been working with a number of private equity shops actually over the last couple of years, who were early adopters, and just in the last couple weeks, months, with some of the activity on the federal stuff, descheduling, rescheduling, SAFE, a lot more people starting to do due diligence. Transactions have been slow to materialize, but we're definitely starting to see uptick, at least from where we sit.
And it's an interesting dichotomy with the potential for action at the federal level, and then what we've been seeing just generally in the economy and in the marketplace, and rising interest rates, and how that can affect not only the cannabis industry but the entire economy. James, I'd be interesting to just hear your thoughts on how you're looking at lending in this environment, and,
Sure.
and how some of those macro factors might weigh in.
Yeah, 2024 is going to be an interesting year. Rates are going to stay higher for longer. We've already seen a number of our competitors in the market, not just within cannabis, just in any other industry, not only tighten up, but really slow down. We know some of the national players are taking hundreds of billions of dollars off their budgets for next year. So you're going to see tightening at a macro level, and I love that opportunity. I think those markets, if you play it right, you can really, and be patient, and you can really find some really good borrowers out there, and you'll get the terms that you want. You'll be dealing with a borrower who probably knows how to handle that market and can see through it. And if you work patiently together, you can overcome anything. And with cannabis specifically, patience is 100% needed for any lender. Commercial lenders are very traditional. They're very stuck in their ways. You have to think outside the box a little bit with cannabis. We spent a lot of time studying the space before we decided to go into it. We put a big task force together. There's a number of people within our institution that touch cannabis from either the lending side, the treasury side, or the compliance side. And it's not for the faint of heart. Like it requires a lot of work. But we built this team with the understanding that there are a number of entrepreneurs out there that deserve traditional banking products, and we would want to be the ones to help support them grow. So again, to kind of flip back to your question, as we look into 2024, I think you'll see a lot of banks be strategic, taking their time with what they want to look at and where they want to do it, and I think we'll see a bit of a pullback.
And in this interest rate environment, can you guys talk a little bit about how maybe the underwriting processes have changed or not? I'm interested in how that progression has been going.
They shouldn't really change.
Yeah, I mean, you just have to look at, obviously, interest coverage and other things like that when interest rates are going up. But yeah, there's an opportunity to deploy capital, and we're seeing good borrowers out there, and we're seeing money to deploy and still raising capital. So the underwriting, I think, everybody's always learning in cannabis, and so the way the market worked 2 years ago is different than the way it's really working and today. And so the ground's constantly shifting as the industry figures itself out. And so we're always reevaluating our underwriting process, always looking at that stuff too, to just say, hey, what do we know now that we didn't know last year, and how do we want to try to protect and deploy capital? But as far as it's, at the end of the day, it's just fundamentals, trying to find good opportunities to put out capital.
Yeah, I think learning from the past few years is definitely key. But prudent underwriting works in good economies and bad, or fast-growing economies or slowdowns. The fundamentals are going to always prevail no matter what. But you do learn some things along the way. There won't be dramatic changes from our end on it. We studied the space long before we went into it. It's really about knowing your borrowers, where they are, what markets they're in, and where they want to go. And if you stick to your prudent underwriting, then things should work out successfully.
I think from where I sit, which is usually across the table from these guys representing borrowers, I think it's actually gotten harder, even in spite of the macro news. The backup in rates, backup in the curve, just the lack of other borrowers around. I feel like the lending environment's gotten even more difficult in the last 3 to 4 months, having worked on the number of transactions. Still very, very, very challenging.
Right, and there's been discussion of there still being plenty of opportunities to find those good borrowers, and there's a number of operators in the audience today. Could you talk a little bit about what you're really looking for in profitability, real estate assets? But can you get into a little bit of just to what folks should be thinking about when they want to make themselves attractive as a potential capital source?
Yeah, I mean, I can touch on some of it. It depends on where they're at in the market and growth cycle. We're one of the few lenders that'll do construction financing and more, early stage. And so what qualifies in that is a little bit different. Usually you're going to have some equity to bring to the table. We're not going to give you 100% of the cost of your project. So that's been a gating issue, I think, a lot of this year, just because the equity raising environment has been challenging. But it's how you're positioned in the market. Are you cash flow positive if you have that? And then really looking through and saying, do we think that they have a unique position in the market? And right now, what's really been winning is vertical integration. So, we see a life cycle of every industry, every state, and we've seen it enough times now. It happens everywhere. Market comes online, a lot of demand, not enough legal supply. Prices are through the roof. It's very easy to make money. Operators don't have to be efficient. And then you go through a period of oversupply. The weaker guys tend to go under, and then it forces you into being efficient, specifically on the expense side. And we've seen operators, typically the smaller guys are the ones that are able to make that pivot quicker. But we're just seeing that across our portfolio and across the industry, people are paying attention to that expense line item and driving profitability.
I think we're focused on what are the competitive moats that can provide a defense against that volatility and that natural life cycle of the industry in any market. And that could be diversification across multiple states and a lot of locations. That could be real estate and hard assets. That could be the pipeline of new states that are coming online in the next year. But I think particularly when you're looking at lending against cash flows in a more mature business, that's what we're looking for, something that protects those existing cash flows that will service debt.
On the private side, I think the criteria has drastically changed. And it's not just cannabis VC investing per se, but also general VC. Just to put for context, right, December of 2021, valuations were at an all-time high in venture capital investing from multiple perspectives and the history of the industry, really. And cannabis was no exception to that. And it's the environment's drastically changed since then. And in cannabis, I think the pressure is even on these operators more so in the sense that we suffer from exorbitant taxes on the plant touching side, non-plant touching side. That the TAM, for a SaaS company, for example, is capped until there's a state that sort of liberalizes. So the criteria is super strict for us in regards to the companies that we think are attractive. There cannot, I mean, a very simple criteria for us, right? There cannot be a monumental change in the market that is required for your business to either become profitable or reach a certain growth profile. Like, we have to be able to see a path to profitability, one, and the growth that you're projecting, two, within the current state of the market. Like, full stop. Obviously, differentiation is inherent in VC, generally speaking. You're looking at deploying to innovative businesses, or folks that are doing something a little bit different outside of the box. But the appetite for cash burn is at an all-time low right now, for sure.
Yeah, I think the most successful borrowers in this market are definitely, and what guys here are looking for, is the quality of the management team.
100%.
And those that run their business more like PE versus VC and planting flags. And that's really the most important element that I think, at least as far as that we talk to.
Yeah, that's absolutely right. I mean, character, planning, what we don't want to see is people who are not prepared for saturation, right? If you're not ready for that, if you have no expertise or no ability to manage through it, then you're going to have a problem, right? So, but to your point, like sponsor's background, we want to know really well. A lot of people are new to cannabis, but they have other like-minded businesses where they can apply skill sets to, they can bring in the right type of people. And we want to see a good plan. We want to understand exactly what they want to do, where they need to go, and how they think they can do it, and we'll guide them along the way. But nobody has a crystal ball, and you definitely don't want to see projections keep going up, 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 and up forever, because that tells me you're not prepared for saturation. We want to understand what you're going to do in the future when that time comes, how you're going to manage through it, and what's the plan for it.
Right. And on a somewhat related note, how do you look at ancillary businesses and how their sort of path to profitability is, as well as potential investments? How does that process differ versus just plant touching, cultivation, retail? Anything interesting happening on the ancillary side?
I think, go ahead, Samara.
No, you please.
Okay. Very similar processes. Everybody's looking for the same criterion. Ancillary plant touching, obviously gets the same type of scrutiny. There's a lot of activity, and it's a lot easier on the non-plant touching ancillary. And I think the biggest change there is, for instance, on the biotech side and trying to get, there's a lot of activity with venture funds and private equity funds from the healthcare space, trying to come in and look at that part of the business in terms of going through FDA processes, getting drugs approved that are cannabinoid-based for that particular vertical.
Yeah, I mean, to qualify for our current fund, you have to own your real estate, so that's generally not an ancillary business. But we do have some people in our book that are chasing some of those things he's talking about while running a cultivation business. So we think there's a lot of potential there.
We've decided to focus only on plant touching entities, and so we really haven't delved into ancillaries significantly.
I like the ancillaries. We call them indirects. They're non-cannabis touching companies. They might do the racking or the lighting or something like that. We like them. They are a little bit more traditional borrowers for a commercial bank. They have hard assets. They're producing something. They tend to be local to where the cannabis operators are. So there's some synergies there. I like it. I think they deserve all the support too that any other company deserves. And it also helps us diversify our portfolio a little bit too. So we're happy to support them when the time comes.
So we do a lot of ancillary services investing, and I would bundle tech into that too, cannabis-focused technology. Starting as early as 2019, and actually we've increased, our weighting in that subsector. I think for us on those, one, it's great because they're typically, as long as it's not equipment focused, they're typically highly profitable. They also don't suffer from taxes, obviously, like a plant touching company, but ultimately their customers are plant touching companies. So the biggest thing for us is, in 3 years ago, tech companies it was an easy sale to get a SaaS contract across the desk of an operator. The operator was hyped up, they typically raised a bunch of cash, trying out different things on whether it's POS systems in their stores, e-com systems for online ordering, crop monitoring systems in the grow, maybe it's B2B transaction processing in the wholesale line, whatever it was. I mean, they were pretty eager to bring them in-house to understand that it could improve their business. Now they're obviously much more stingy. So for us to be able to be comfortable investing in an ancillary services company, that service has to be essential. Truly, truly essential to these operators. A lot of them pitch on ROI, show me very tangibly what that ROI is, right? If you're saying you're going to help a grower increase yield, like we want to be out in the facility seeing those increase in yields, not, a model, which anybody can sort of create showing us that, your grams per square foot goes up, things like that. So it's just sharpening the pencils and making sure these companies are providing something that operators are willing to purchase and continue to repurchase. I think is a more important thing. So for us, it's still a focus.
And in terms of sharpening the pencils, right, whether it's in a new business type or a new market, I'd be interested to hear your thoughts on new markets that come online. We were talking about the Midwest, and we have New York. What is the process for evaluating those types of new markets and the opportunities that they present?
So when we're looking at a new market, and something that we have, I think is a little different than others, is because the data didn't exist to understand these markets, we had to go out and get it. None of the traditional data providers would actually track cannabis real estate or other things that were happening. And so we, in 2020, founded a separate data company, and we've been scraping data today over 100 different sources into a proprietary database that we use to help us understand markets as they come online. And it's really about looking through that looking through that first wave of easy profitability, easy money, and then getting down what does saturation, to James' point, look like, and what do we think, what markets do we think are oversupplied for cultivation facilities today? Which ones do we think are undersupplied in retail? And you can see, or distribution, and we can see like pockets of opportunity in these markets, and try to understand the licensing regime as they roll it out. How is it going to work? What are the potential opportunities and pitfalls into this licensing strategy? And some of it you have to kind of wait and see, but we come up with this is what we think is going to play out, and this is where we want to place our bets.
I think also handicapping the next rec conversion is probably the biggest play for most people. Just trying to figure out where they're headed next, what states are moving towards rec. We're seeing a lot of activity in the South, Southeast, where we've always been busy starting in Florida, but migrating further towards the bayou and everything else. So there's just quite a bit of activity in the Southeast.
And Peter, could you talk a little bit about investing in social equity and what that looks like? I mean, the big discussion now is New York, and could you talk about that?
Yeah, sure. We've seen a lot of social equity programs rolled out across the U.S., some more successfully than others, but generally disappointing in their execution. And one of the challenges among many of a lot of these programs has been that there's no partnering of social equity capital tied to the issuance of social equity licenses. And if you don't have the capital, you can't get them stood up without the people that you're looking to benefit having to give away most of the economics of these businesses. And I think we've seen that time and time again in every state that's tried. New York took a different approach. One, they sought to give an advantage to their social equity applicants in terms of who gets licensed first, and that's hit roadblocks in the courts. But they also created a social equity fund that we partnered with the state of New York to commit to. That's $200 million, fully committed capital, dedicated to identifying real estate for retail properties across the state and executing on the tenant improvements on those real estate sites, and then delivering to social equity applicants a fully built-out dispensary that's ready to go absent the working capital for your first few months of payroll and your first inventory, with the aim that we've really limited the capital need for a social equity applicant in New York to what would be $1 to $2 million to a couple $100,000. With this $200 million, we hope to do somewhere between 100 to 200 dispensaries in the next 3 years, and we'll be judged on the execution. And I'm hoping that other states take this example and put something in similar, because it's not rocket science. It's just bringing money to the table and bringing execution to the table to solve what was a gap in really any social equity financing that's happened anywhere else across the country. And we think it's the largest commitment to social equity financing that's been done in the space.
And so is there any expectations on that maybe coming to other markets, or it's let's see how New York goes and then kind of take it from there?
We would love to. We're certainly open to conversations with other regulators. We've deployed about $20 million from Chicago Atlantic in New York in this quarter, and hopefully there will be more to come in other states. But the first step is really a regulatory body and governor's office backing that wants to put social equity financing as a priority. And that was certainly the case in New York, and we hope other offices will follow. And whether that's with Chicago Atlantic or with anyone on the stage or anyone in the industry, really more money into the industry benefits everyone.
Agreed.
So to turn things a little bit, I did want to touch, we briefly touched on M&A. Just wanted to hear your thoughts on whether you think there may be an uptick in activity as equities maybe come back, or just interested on your thoughts on the M&A markets.
Yeah, clearly M&A's picked up after a really rough patch. and public valuations have certainly bounced quite a bit, so people are now more open to taking stock. I think that the disconnect is the private markets are probably still overvalued in their mindset. So there's still quite a wide spread between the bid and the ask. In my mind, people are still husbanding cash and trying to use as much seller financing, whether it be a note or stock. So there is more receptivity to taking stock now from the headlines over the last couple of weeks. So I think the M&A market should be pretty positive.
And in terms of the M&A markets and where valuations are, does this recent wave of distress change the strategy at all? Is there a level of waiting for what's to come, or is it just, just keep doing what you're doing? I'd be interested to hear.
I think there's places to deploy capital now, and there's certain borrowers and certain companies that you want to wait and see how it kind of plays out. I think if you're thinking about it from an M&A perspective, there's a lot of people lining up that would love to do distressed valuations in M&A, and it's really about trying to control your own destiny if you're a company at that point, because if you're cash flow positive, you can wait for all these positive catalysts. And so I think if there's not a clear path to that in the near term, you may be forced to do a deal to survive, whereas focus on the bottom line and buy yourself some time, and then prove out your strategy. And there's a lot of opportunity, I think, and it puts you in a stronger position.
Right. And on that strategy side, when you're talking about, we talked about things that borrowers and potential investment targets can do to attract capital. I'd be interested to hear on the flip side of maybe some red flags or some interesting stories. We don't have to hear any names, but just some war stories that people can also be careful, that things to avoid as they're looking to go out and raise capital.
I get the speech all the time. We have the best product ever. Like that. That's great. I would love that you believe that. But at the same time, when they come to me and that their plan is a mess, they're not organized, they don't have the right people in place, it's hard to believe it. They're behind on this project, they're behind on construction here, they have plans to integrate wine or cheese over here and do this other thing over here. I'm just like, you're not focused on what you need to do, which is build a really good foundation. So we see a lot of just people who just think it's a gold rush, think they've struck it, and just because they're in cannabis, they think they're going to be millionaires in a few years, and it's just not the case, right? It's a ridiculously hard industry to be profitable in, and they just really don't focus on their bottom line as much as they should.
Yeah, I think character is a big thing. Like we try to identify that in our borrowers and people on the other side. I come from traditional industry, and there's been a gap in character in the cannabis space. And I don't know if it's because it was illegal before and now it's become legal, but it's interesting. I think it's part of the maturation of the space. But when you talk about war stories, I was looking at a deal once, and this guy sent over the pro forma. So we look at it, and then a week later, we get another pro forma. It's about 40% higher on everything.
Nice.
And we go, well, wait a second, what's going on here? And so I call him, I said, these numbers are shifting. And he said, well, Travis, you have the pro forma that you show investors, and then you have your real pro forma? And I go, that's not how this space works. That's not how business works. We're not even going to continue discussions.
We've found that the truth always comes out in the data, that when you're looking at cultivation, when you dig into yield per square foot and use a consistent methodology of that, and evaluating their strain choices, evaluating their retail choices, and looking at POS data directly, that it all flows out in the numbers.
I think in spite of the news, positive news over the last couple of weeks, months, in terms of some of the macro stuff, there's still a lot of distress out there, especially with the large privates. There's still a lot. And even if everything passes tomorrow, I think it's going to be, and it's not, it's going to be at least another year and a half before it filters through to the system and things open up. So I think there's still a period of distress ahead of us before things really start to turn up.
And Robert, be interested in your thoughts. Any examples as well?
I'm trying to think of a war story that doesn't put anyone on blast, so to speak, but because there are a lot. Listen, I think there are certain pockets in space that we've looked at. There's always hot topics that kind of pop up in areas of disruption. A really great one for us is biosynthetic, right? So there was a really big wave of operators that popped up seeking capital that were attempting to brew cannabinoids, right? Where you take some sort of organism, most likely yeast, you feed it sugar, and through this long scientific process, it excretes cannabinoids. And then if you put up a bunch of big sort of silos within similar to how biofuels are created in a large facility, you can eliminate the need to grow cannabis, right? Any formulated product can just use the cannabinoids that come from that. I mean, there were probably 20 to 30 companies in the last 4 years that had popped up, attempted to raise capital. For the number of companies that we passed on, and we were, in one case, we were actually called small-minded after passing on a couple, just because we didn't realize the value of this stuff. And I think the point being is cannabis pricing is extremely volatile. In order for the economies of scale to make sense for synthesized cannabinoids, like, we need to be pretty confident in how cannabis is priced. Just how you need to be pretty confident in how gas is priced in order to purchase biofuels, right? And the amount of bankruptcies that we have seen come across the tape for biosynthetic companies has been ridiculous. So it's a very specific example, but one of those things that you have to rely on your gut, and you also have to be really detailed in your due diligence processes, and pay attention and adhere to your guidelines for investing, right? There's a lot of people out here that are extremely bullish about the things they're creating or doing, and it is still, regardless of the fact that we've been in this space for, the legal industry has existed for 10, 15 years in the U.S., it is seriously, seriously early still. And a lot of people forget that. So we try to remind ourselves constantly, which to me is the opposite of being small-minded, but apparently not in that specific situation.
It's all relative. But I appreciate everyone joining today. We do have time for maybe one or two questions from the audience. So if anyone is interested in asking a question, we could probably take one or two. Or if people want lunch. But yeah, right here.
My company, my brand, is very much so a cannabis brand, but it also developed into other aspects of wellness. And I'm just curious if, because of that, would that maybe give me more of an opportunity for chancing getting financing, having another aspect of my business opposed to just being 100% cannabis?
Yeah, I mean, I could touch on it, and maybe James has
Yeah, I can take it.
Yeah, you take it.
Well, if you own the real estate, you have more of a chance anywhere. Some banks take a couple different approaches. Some are all or nothing, meaning even if you have 1% of your business from cannabis, they'll take you out. Some have a 25% rule, where if your revenue is 25% or less from cannabis, they'll take a look at you. So it all depends on those couple of factors. You're gonna have to dial around a lot, that's for sure. Sometimes it's the 30th banker that you reach is the one that you've been looking for the whole time. But just keep your head up, keep going, and it's going to be hard next year for sure if you're looking for financing into Q1. But there'll be people lending for sure, and just keep dialing, buddy. Yeah.
American folks wish to invest or lend money to, one of the criteria obviously is positive cash flow profitability. Brings me to 280E rescheduling question. People are saying that the administration would like to see the rescheduling happen before the election. A lot of people from the DEA is on board with that because they have a record of not going against the HHS supposedly. So the question is, presuming that 280, that cannabis is rescheduled 3, what kind of an impact is that going to have on 280? And are companies going to go? I've heard people say it's going to be a game changer. Where we go from not being profitable to being profitable. Do you guys see it, so black and white? And if that is the case, what is that going to do to investments in the cannabis industry?
Time will tell. It's fundamentals are just always going to be necessary to build any business, let alone what one line item on the P&L says, right? Like, I think this is a good time for people to focus on their foundation, focus on getting profitable if they're on the cusp, focus on efficiency and effectiveness, and understanding that 2024's macro environment could be difficult, period, let alone rescheduling or anything else. So I think there'll be opportunity for people to certainly boost what they've built when that happens, and time will tell. But if you don't have a good operation, it kind of doesn't matter, right? Like you need to be operating efficiently, effectively in any market at any time, and that will reign supreme. And then your management team should be figuring out how to navigate any of those storms that come along the way, whether they're political storms or they're competitive storms or they're interest rate environments. Like that's what the management team is going to be focused on. So
I think it's obviously a huge positive if it happens, and when it happens, whether that's through rescheduling, descheduling, safe, whatever it is. I'm not sure yet. I've read differing opinions on that, but clearly, to answer your question, it's obviously a huge positive.
Well, we are officially out of time, but really grateful for our panelists. We really appreciate your perspectives, and without further ado, lunch.
thanks, Max.